All right, another down day, 30 minutes until the start of the cash trade here in the U.S. I'm Matt Miller.
I'm Sonali Basak. Katie Greifeld is on assignment today, and Bloomberg Open Interest starts right now.
Coming up, L.A. fires still raging as Santa Ana winds are poised to intensify the wildfire battle. We'll take you to the front lines. And stock traders have been rattled, hit by diminishing bets on Fed rate cuts as Apple's iPhone sales fall 5% in the holiday quarter. Plus, it's Merger Monday. J&J agrees to buy Intracellular Therapies for over $14 billion. Katie Greifeld is in the midst of all of that pharma action at the J.P. Morgan Healthcare Conference in San Francisco. She's going to bring us interviews with the CEOs of Eli Lilly, Teva, and GSK. Let's take a look right now where the markets are trading. It is a down day in terms of futures. S&P futures off 0.7% on continued concerns about fewer Fed rate cuts than previously we would have expected. We closed on Friday at lower than we opened on November 6th, the day after the Trump election. So all of those gains have been wasted away. The 10-year yield is one of the main problems. We are 52 basis points higher than we were on November 6th. When you look at the 10-year yield, 477, the fear is 5%, and it is approaching rapidly. NYMEX crude oil is one that a lot of people may not have had on their bingo cards as much higher post Donald Trump. It's $6 more than it was on the morning of November 6th at $77.79, and Brent crude over $78 a barrel. One of the biggest moves that we've seen post-election is in the dollar. This is the Bloomberg Dollar Index. I have a 5-year look just so you can see that we're getting closer and closer to the peak that we saw in 2022. This was on a Fed rate cycle. We're now in a Fed cut cycle. And yet, the Bloomberg Dollar Index is stronger than it's been in more than 2 years, Sonali.
That 10-year was almost touching 4.8% this morning. I almost shook you, but I figured I'd let you wake up. It's only Monday, right now, after all. Anyway, some stocks we're also watching. We're looking at a lot of retailers here today. There's been a lot of news. Macy's gave a downbeat outlook for sales in the current quarter after holiday spending failed to deliver at the country's largest department store. You do see Macy's down now 1.7% pre-market, but Lululemon is on the rise, up 2% or more pre-market. Sales for the current quarter beats Wall Street's expectations despite a consumer spending slowdown. Abercrombie & Fitch, it raised its sales outlook, but the increase was not enough to reassure investors of fast growth. Abercrombie now down more than 9.4% pre-market, but of course we know that's been a high-flying stock, Matt. A lot of dispersion, though, right now in the trade when you look at across sectors.
All right, so it feels like generally the tone is very somber when it comes to markets. The blowout jobs number that we had on Friday, adding, I think, 256,000 jobs, really drove a lot of bets on the Fed not only no longer cutting, but some banks thinking they may even raise now in this year as inflation becomes a real worry. We have PPI coming out, I believe, on Tuesday, and CPI coming out on Wednesday. We're looking at 3% plus jumps on both of those, especially if you look at the core number year over year. I think 3.8% is the expectation for producer prices. So a lot to talk about today. And Sonali, you sent a note from Ed Yardeni explaining that he thinks, it could get worse here, but maybe a buying opportunity.
Yeah, I think this is fascinating. He said that some of the pullbacks that we've been seeing could turn into corrections of more than 10%, but less than 20% this coming week if Tuesday's CPI inflation rate for December is higher than expected. Investors more and more worried here about that 5% level on the 10-year. Stuart Kaiser over at Citigroup sees an S&P move 1% of either way, depending on how CPI behaves. Of course, we have PPI before that. let's see where it all goes. At the end of the day, you seriously do have a risk-off attitude underpinning the markets at the very least, all just ahead of bank earnings starting earnings season.
Yeah, and these big mega cap stocks are down. I'm looking at NVIDIA right now, trading off 3.6% in the pre-market. Let's bring in Bloomberg's Danny Berger. She anchors the brief for us, and she's been watching these big mega cap stocks lose ground this year.
I have to say, just looking at that Yardeni quote, I mean, of course, Max Kettner is also out with a note saying that this is an opportunity because they went in so bullish this year.
Dan Ives also has been bullish and says this is a buying opportunity.
Correct. Dan Ives out with a note saying, tech might sell off, but it's going to be okay. That's part of the problem, right? And part of why we've seen this vicious reaction is that sentiment was maybe overstretched. Valuations were high. So you get a data that comes in that sells yields higher. It's very clear where the reaction has been. It's been in rate sensitive, the mega cap stocks that are already long duration type stocks and small caps where you have a lot of floating rate debt. Now, in terms of whether or not it lasts, the bulls, as it were, point to the idea of why rates are going higher. If it's because of good economic data, because the labor market is strong, then earnings will be good and these stocks will come back. If it is because of inflation, if oil becomes more of a story, then maybe it's not so good, and maybe that's a reason you could have an enduring sell-off.
You know, you look at the sell-off, you have NVIDIA now looking at erasing its year-to-date gains, and that would bring most of the Mag 7 this year so far early in the year, but it would bring it in the red. All of them are negative on the year. So what does that mean in terms of expectations for earnings and what these companies have to show? We just reported, Danny, that NVIDIA is looking at tie-ups with more health companies, for example, to expand its product base. Clearly, the market's not yet really biting on these, frankly, marginal announcements that are coming out from these companies.
Yeah, it's not only that one. It's also CES, NVIDIA saying we're going to get into robotics and we're going to get into autos. The market took that as a disappointment. And again, it comes back to this idea of just how much we've rallied at this point. You need to come out with something big. With NVIDIA, it's about the hyperscalers continuing to spend. I mean, you mentioned Apple. What a bad time to see sales that look like they dropped about 5% in China year over year. A time where you have valuations that are stretched. A time when you're worried about trade tensions. It is a bad cocktail of things. And when rates are where they are, if they're getting near the danger zone of 5% and valuations are high, you need to put out stellar performances and more exciting announcements, I guess, in the case of NVIDIA, to actually excite investors.
Apple now down more than 5% this year, extending declines even this morning after that latest iPhone news. And frankly, Apple, Amazon are also consumer stocks, Matt. So that's another place where the rubber hits the road.
Right. Well, I mean, hopefully, as Danny pointed out, you know, a stronger labor market can mean good things for their earnings. In terms of the NVIDIA story, that they're going to have tie-ups with the Mayo Clinic and Illumina, I mean, who wouldn't have expected those companies to be using AI anyway? I will just say, as a footnote, Katie Greifeld out at the JP Morgan Healthcare Conference is going to interview the CEO of Illumina tomorrow, so I'm sure we'll get more on this media announcement.
Danny, thank you so much for joining us. Of course, now we're going to turn now to Bank of America's head of U.S. small and mid-cap strategy, Jill Carey Hall, another person to talk about this higher for longer rate environment with here. Jill, when you think about 5% on the 10-year, small caps, mid caps, it's where investors get the most worried. What's the read-through?
Thanks for having me. Yeah, I think the latest payrolls report on Friday underscores our caution on small caps. We think mid caps are an area within the SMID universe that offer better risk reward as we head into 2025 now. And I think the fact that our economists are now expecting no more Fed cuts this year, they expect the Fed to remain on hold after what we saw on Friday, you know, that causes refinancing risk for small caps to be a risk that reemerges. You know, this could be a pretty significant hit to operating earnings over the next 5 years. Small caps have a lot more short-term and floating rate debt. They have a lot more debt that's coming due over the next 5 years. They're also more sensitive to long rates. So as you know, the 10-year Treasury yield has continued to rise. This becomes a bigger risk for smaller companies. They're longer duration. A lot of these companies also are non-profitable. So this is all at a time where, you know, as we're heading into earnings season, small caps have still struggled to emerge from their profits recession. Analysts are still expecting negative year-over-year earnings growth for small caps, and you know, this has been a big disappointment relative to a year ago. Analysts had been expecting a much bigger recovery for small cap earnings.
Jill, where is the best place to buy small and mid cap stocks? I mean, we hear about, you mentioned the unprofitable scenarios here. I think 40% maybe of the Russell 2000 is unprofitable. I wonder how that looks on the S&P 400. Are there certain industry groups on those two indexes where you see more profitability and less reliance on, necessary refinancing?
That's right. Yeah, about 35% of companies in the Russell 2000 are non-profitable, and this is stayed elevated. We've had two recent earnings recessions, COVID and the one over the past year or so. We've also had after the IPO boom in 2020, 2021, more and more non-profitable stocks get added to the index, biotech, small cap software, some of these areas. So within small caps, the S&P 600 is a higher quality index than the Russell 2000. And then, we do think tilting up the cap spectrum toward mid caps, mid caps have seen better fundamental trends, better revision trends. They have less refinancing risk, less leverage than small caps do. We also think they have less policy risk post-election if we are to see tariffs and immigration reform relative to small caps and the potential earnings hit they could face. So we do like mid caps over small. We also think this is going to be a year where you want to focus on stock selection over just buying indices. Obviously, post-election policies and many of the themes that are going on would suggest that stocks and subsectors could react differently. We're still seeing high valuation dispersion, so lots of both cheap and expensive stocks within the market. So we focus on economically sensitive stocks that have low balance sheet and refinancing risk. We still think CapEx spending by corporates will pick up, so stocks that can benefit from that, but don't have a lot of leverage will benefit. Stocks that are just seeing positive revisions rather than negative revisions have held up well. And then from a sector perspective, we think financials looks attractive. It's screened well in our work. Obviously large cap banks, could see some of the biggest benefit, but even within small and mid caps, this sector ranks relatively well in our work.
Jill, just one moment here, because we do have some breaking news from the information now that is sending NVIDIA shares a little lower. They were already lower by more than 3% this morning, now lower by more than 4%, extending declines because, according to the information, customers are cutting NVIDIA Blackwell GB200 racks orders. Those customers include some of their largest customers, Matt, including Microsoft, AWS, Google, and Meta. So sky-high expectations really
all of the other
hitting
Mag
the ground
7
here.
stocks cutting their orders with NVIDIA. That is headline. I mean, look, the stock was already down, 3.8, 3.9% at its lowest levels of the session, not being helped by the news or the press release that Illumina and the Mayo Clinic are going to be using AI. Of course they are. But this is a problem. If big customers like Microsoft, AWS, Google, and Meta are all cutting orders on the Blackwell chips, or at least the GB200 racks, this, according to the information, we haven't independently verified that, it's not great news for NVIDIA. Okay, so the biggest caps in the world, from the small caps to the big caps. Jill, thanks so much for joining us. Jill Carey Hall there, BofA, head of U.S. small and mid cap strategy. We got to get you back on a day when it's not the big stocks making the news. Coming up, crews battling the L.A. wildfires face a new threat this week with more Santa Ana winds expected. We'll head to Altadena, California next. This is Bloomberg.
Now, residents and firefighters in Southern California are bracing for at least 2 more vicious rounds of dry winds early this week. The powerful gusts are expected to challenge crews struggling to contain 2 destructive blazes, which have left at least 24 people dead and destroyed over 12,000 buildings. AccuWeather has raised its estimate for wildfire damages and economic losses to between $250 billion to $275 billion, and that's up from $135 billion to $150 billion. Bloomberg Intelligence anticipates the Palisades fire will likely be the highest insured fire loss ever. The problem here, Matt, is that you are looking at a fire here at which the insurance losses will only cover a very small percentage at the end of the day, really, of what will actually be damaged. More than 12,000 structures.
Yeah, I mean, so it's I think TBD what exactly officials mean by structures. That could be also a shed in your backyard or a carport. But it is for sure that a lot of these homes aren't covered by insurance. There is a program in place that may not be terribly solvent, the FAIR program in California, that should cover up to $3 million in losses. But of course, many of these homes are $5-6 million houses.
They're already going to have to look at raising more money for that fund. We're going to go now to ABC's Zoreen Shah. She is in the Altadena fire zone. Zoreen, tell us what you're seeing on the ground.
Yeah, I can tell you that, but just to bounce off what you were just talking about, the California FAIR Plan, that's actually the insurance I have. I can talk to you about it quite a bit. It's from the state. I lost my home in this fire. We were thankfully insured, but there are a lot of questions about this insurance. Will they be able to pay everyone out? Will they be able to pay everyone out the max amount? And how on earth is this insurance going to continue to last when so many homes are just completely decimated? But in terms of where we are right now, we are in Altadena. This entire area, it looks like a war zone. I have 3 friends who have lost their homes in this area. They are just in incredible grief and disbelief right now. A lot of them did not have the type of insurance they probably would have had they known their house was going to burn to the ground. The winds are expected to be incredibly intense today as well, up to 75 miles per hour in some parts of Southern California. Forecasters are issuing a rare warning called a PDS, or a particularly dangerous situation. And we are not in the clear at all. There's a lot of homes still threatened, and this is a very scary scenario for a lot of people.
So, Zoreen, where do you go? Your friends who've lost their houses, the tens of thousands of people who are stranded now. I imagine there are hotel rooms for some, or you can sleep on a friend's couch for others. But what's the longer-term solution to people who aren't going to get back into their homes for not just months, but possibly years?
Yeah, it's a good question. I mean, look, insurance does, if people have fire insurance, it will cover a lot of that for, yes, up to 2 years. But right now, a lot of these folks, they're staying at friends' homes, they're staying at hotels, and they're just waiting to sort of figure out their next steps. But people who do have fire insurance, like the Woolsey fire that happened a few years ago, I've been in touch with a lot of people from that fire trying to figure out how they navigated. They do say that fire insurance will cover a lot of time in a hotel or another home.
All right, Zoreen, thanks very much. Zoreen Shah there covering the fires for ABC. Really appreciate your time, and very sorry for the losses that you're all looking at in this tragic fire. I want to go from that. It feels wrong, but I'm going to go from that back to the markets. Of course, that's what we cover here. And they're not looking that great either this morning. S&P futures are down only 0.7%. But keep in mind that we closed on Friday at a lower level than we opened up on November 6th. So all of the Trump bump that we saw since the election is now gone from this market. NASDAQ futures down even more than 1%, as we see NVIDIA falling more than 4% on the news from the information that Meta, as well as AWS, Google, and Microsoft are all pulling orders for the GB200 racks that hold the Blackwell chips. Russell 2000 futures down just as much as well as we see rates rise. Chanel, you pointed out earlier that, we saw the 10-year get to almost 4.8%. It was, I think, 4.79 and change at one point. And we're not far off from that now. So these rates continue to scare investors.
It's also very volatile. You look at it, we're right below 4.7% right now. But just this morning, hours ago, we were touching that almost 4.8% level. You have to wonder if investors, more and more, you're seeing 5%, 5%, 5% in every note. Investors are preparing for 5%. Are they preparing for 5.5%? I mean, what's the upper bound? When no one's willing to call it, then how difficult is it to invest in this environment?
Yeah, I mean, couple that with the fact that oil is a lot stronger than many people would have expected, with Brent up over $80 a barrel now. We're just knocking on that door, I think 77 and change with West Texas Intermediate. And then you've got the strength of the dollar. Mike Wilson out this morning with a note saying that although on the whole, the S&P only gets about 30% or less of its revenue from international buyers, there are some companies that are really pointed in that direction. When you think of the hardware, technology hardware makers, for example. When you think of household goods makers, for example, food and beverage stocks, for example, getting a lot of their revenue from overseas. And when the dollar rises like this, it's been a huge jump since the election. It's problematic, to say the least.
You know, I think a lot of investors take a while to realize the rest of the world's problems become our own. You think about that just with Apple, for example, and when you think about the weaknesses in China, it impacts one of the biggest stocks that we're looking at here in the Magnificent Seven. Now, I think we really have to start asking the question, if you do have inflation expectations rising, yields riding higher, is the consumer going to cause a dent in this equity market story too? Yeah,
absolutely. We'll get that inflation data tomorrow and Wednesday. We're going to come back with more on these moving markets. This is Bloomberg. Let's get now to high interest. A look at what's making headlines around the world. Ceasefire talks between Israel and Hamas are making progress. Israeli officials told Bloomberg they've presented a detailed outline in a second day of indirect discussions in Qatar and are awaiting approval. Incoming U.S. Vice President J.D. Vance says a deal to release hostages held by Hamas could be struck before President-elect Donald Trump returns to the White House, and he did promise that would be the case. President-elect Donald Trump met with House Republicans from New York, California, and New Jersey over the weekend. On the agenda, state and local tax deductions, or SALT. The representatives from those high-tax states felt support and said the talks were positive, but Trump made no firm commitments at this meeting. But remember, when he was on Long Island, he promised he was going to get rid of the SALT cap that he put in place in 2017. And a significant milestone for Tesla as the EV maker overtakes Audi in global car sales for the first time. That's even though the company sold fewer vehicles than expected. Audi, which is owned by Volkswagen, saw annual sales slump 12% due to intensifying competition in Europe and China.
I check on futures here, of course, because we are looking at a really down day in markets here. We're looking at S&P that is down 0.8% before the market opens. Futures for the NASDAQ down more than 1%. Same for the Russell 2000. Stick with us. We're less than 4 minutes from the opening bell. We are going to talk about what's causing the sell-off. This is Bloomberg.
Moments away from the start of trading on this Monday morning. This is Bloomberg Open Interest. I'm Matt Miller. Futures are lower and continue to get worse as we approach the open. Now down 0.8% on the S&P. NASDAQ futures down 1.2% as NVIDIA falls more than 4% in the pre-market. Russell futures down 1%. Here at the opening bell on the New York Stock Exchange, Citi is celebrating Martin Luther King Day, or honoring Martin Luther King Day 1 week early, of course. On Martin Luther King Day next week, we're going to have a couple of events like the inauguration and, more importantly, the National Football Championship for college. On the NASDAQ, you see what says NASDAQ Entrepreneurial Center. I'm pretty sure those guys are from Invesco, because NASDAQ and Invesco have put together a biotech IPO, and so they're ringing the bell today. In terms of the stocks that we're watching today, Apple is one of them. Remember, we told you that iPhone sales fell 5% in the last quarter. Not a huge surprise, but just a reminder that it's an issue, and Apple shares are some of the worst performers of the Mag 7. I think Sonali said they're the worst performers this year. You're looking at the live indexes there, but here's Apple down 2%. You see some of the other Mag 7 stocks taking a leg even lower today. NVIDIA, obviously, is the big one, down more than 4% after the information came out with a report that Microsoft, AWS, Google, and Meta are all pulling orders for the Blackwell chips, at least for the racks, the GB200 racks. Here, NVIDIA down 3.7%. And when a $3.5 trillion stock loses 3.5%, that's guaranteed to weigh on the indexes on which it's listed. Sonali, what are you watching?
Well, it's incredible. The Mag 7, only 2 stocks in the green still. Let's see if that holds today. There are some other areas of green, but Really a lot of red on the screen. Macy's down another 3% as the market opens. It trimmed its sales outlook after the holidays had failed to deliver for investors. Remember, there were high hopes, now down more than 3.3%. Abercrombie down another 9% as well. Lululemon is up on the day so far. They're bullish on sales for the current quarter. Abercrombie's getting some negative sentiment even after raising its guidance, down almost 9%. Really interested here, Matt, to see what's going to happen with CPI and what happens to these consumer stocks later this week. Flip up the board also here. I want to also talk about Johnson & Johnson. Mega deal here that we're looking at. Intracellular therapies up now 35% as the market opens. J&J is going to be buying them for $14 billion. That's a 39% premium to Intracellular's closing price on Friday. We're going to now bring in Katie Greifeld. She's at the JP Morgan Health Conference in San Francisco. Hey, Katie, you know, what a morning to start with a bang here. A mega deal in the healthcare space. What does it mean for J&J, and is everyone talking about it?
Yeah, there is a ton of news out already. Of course, J&J kicking us off with a bang. Bloomberg reported this news yesterday. The company's confirmed it this morning. So let's go through some of the details here. Like you mentioned, largest biotech deal in over a year. So $14.6 billion is the price tag. That works out to about $132 per share. And some information on Intracellular. So this is a company that focuses on central nervous system disorders. Think mental health and neurological conditions. The reaction from the sell side has been pretty positive so far. You have a note out from Mizuho saying that this is obviously a great outcome for Intracellular there. It was interesting to see Johnson & Johnson a little bit higher as well. And their read of that is that basically it's tough to criticize J&J here for the price tag. This is a revenue generating asset in an area that this company knows very well. So J&J clearly going on the offense when it comes to deal making. Remember, they bought Shockwave back in April as well. J&J is not alone, you guys. Just think in the past 24 hours, we heard that GSK is going to buy drug cancer firm IDRx for up to $1.15 billion. You have Biogen out with a takeover deal for Sage. And just in the last hour or so, we learned that Eli Lilly is going to buy Scorpion Therapeutics' breast cancer program for up to $2.5 billion. So Sonali, you in particular know well, there is a lot of optimism over deal making right now. We're going to try to break more of that news over the next 2 days.
Well, and you're going to be talking to some of these CEOs, right, Katie? I mean, Lilly, we're going to hear your interview with Dave Rickson just about an hour or less. And I think tomorrow you're talking to the CEO of Illumina, which at least announced some sort of cooperation with NVIDIA, one more of the thousands of companies that's going to be using NVIDIA's chips in an AI push.
Yeah, you're right. I know NVIDIA shares not looking too pretty today, but of course, this is good news for Illumina. I think Mayo Clinic also involved in that. But you're right, this is a bit of a rip up the script moment. We are speaking, of course, to Dave Ricks at 10 a.m. Eastern. That'll be really interesting. It's a nice reminder that they do more than just weight loss drugs. We'll also be speaking to GSK's CEO, Emma Walmsley, later on today, of course, about their news in the oncology space and the deal making they're doing there as well. And just in a couple of minutes, we'll be talking to the CEO of Teva as well. So a lot to look forward to.
All right, Katie, thanks very much. We'll talk to you in just a moment. Katie Greifeld there at the JP Morgan Healthcare Conference out in San Francisco. Right now, I want to turn back to markets that are falling. Nimrit Kang joins us, NorthStar Asset Management Chief Investment Officer. Nimrit, it's really, the rise in yields that especially the move that we saw after the non-farm payrolls number came out on Friday, that's putting a damper on this rally, really erasing all of the gains that we've seen since the presidential election. Does this continue? Do we see stocks headed down further?
Matt, it's a rough way to start the year, but not entirely unexpected. So every year on average, we see a 14 to 15% intra-year declines, and yet the equity markets are positive 75% of the time. So, we came in pretty hot and heavy into the year, and there's still a lot of uncertainty. We don't know what the policies are going to look like on taxes, tariffs, immigration, lot to work through. But we think it's a regular intra-year decline that we're seeing in the market here. So nothing that would get us off of being too worried here.
What do you do with the big cap tech stocks here? Because you're looking at every single Magnificent Seven starting the year actually in the red, except for Meta, barring Meta. Meta is actually today the only one in the green. Do you load up on these opportunities at a time where investor after investor has been saying it's time to broaden out the trade?
Sonali, the reason Mag 7 has outperformed to the extent is because their earnings are outpacing everything else. That's the reality that we're contending with. The AI boom is real. Even if you look at the hyperscalers, which are the part of the Mag 7, they're spending something like $200 billion a year in those investments. So that thesis still very much remains intact. Now, if you have missed that rally, maybe now it's a time to, dollar cost average into some of those positions. We own a couple of the Mag 7 names. We've held them for long periods of time. So we're not getting shaken out of our conviction there. We're doing the work. If they get sold off even more, we think that the long-term fundamental trends are very much intact. So we would take these opportunities to add to those exposures.
In terms of what to expect from the Fed, Nimrit, and how much it matters, what's your outlook? I mean, everybody had been pricing in continued cuts this year. Now there are some, Bank of America, saying it's possible that the Fed raises rates this year. What do you see, and how much does it matter to your investment case?
Well, we've been yo-yoing all over the place with the Fed actions. We started off 2024 expecting 6 rate cuts. We got 3, right? And the 10-year, even if you look back to 2024, went all the way from 3.7 to 4.7. Again, all these data-dependent scares that come up to the market. So we think that, yes, anywhere between 4.25 to 5 is a fair value for a 10-year yield. There is a secular long-term pressure upwards on the yields because of the aging demographics. So we've been taking our time to add exposure there as the yields back up. But overall, the Fed remains very data dependent. We've got good prints that's put Fed on pause. That's not to say that down the road, this is so early in the year, we might get some other prints that are not that compelling, and we might have the rate cuts back again on the table again. Not to mention that we still do not have a lot of certainty and visibility on the policies of this incoming administration at this time.
I also want to take note of the VIX at this moment because we are at a 21 handle that is slightly elevated. The 1-year average is about 15. So we are above that for sure. If you think about the data points we have ahead, we have PPI, we have CPI, and investors are still keeping a close eye on inflation here. Do you wait for some of those critical moments to pass before you put on some of these larger trades, given that clearly the market is expecting some more volatility?
Yeah. The background is of higher volatility. Within that, picking exact days is very difficult. So the best way to do is just dollar cost average. We're going to get some of these prints. Some of those are forecast wrong. We know that. And with that assumption, we're just going to kind of, bite the bullet there, and we just leg into our positions as we move forward.
Nimrit, great to get your take today. Thanks so much for joining us. Nimrit Kang there of NorthStar Asset Management. Coming up, we're going to head back to Katie in San Francisco, where she's sitting down with the CEO of Teva Pharmaceuticals, Richard Francis, on a down day in the markets. Also happening now, U.S. National Security Advisor Jake Sullivan is speaking with Bloomberg's Jenny Leonard as the Biden administration enters its final week in office. This is part of our Newsmaker series, and you can listen to the conversation by typing Live Go on your terminal. This is Bloomberg.
Your overarching approach on China, as you mentioned, has been to responsibly manage the relationship so that competition doesn't veer into conflict. Over the last 4 years, but also more recently, we've seen major hacks of
Let's head out to Katie Greifeld in San Francisco. She is at the JP Morgan Healthcare Conference, and she's got the CEO of Teva. Katie?
All right, thank you, Matt. I am here with Teva Pharmaceuticals CEO Richard Francis joining me right now. Nice to see you in person.
Great to be here, Katie. Thanks for having me.
So let's talk about the past year that you've had, because you take a look at your share performance, shares up 111% last year alone. That is your second best performance on record. How do you plan to keep that momentum going in 2025?
Well, so thank you for having us, and thank you for recognizing that. And maybe could I just take a moment to bask in the fact that the team have achieved that. And I'm really proud of the team at Teva because we've had some tough times, and to come back with that share growth happens because we've done a lot of things well. And I think it's primarily been driven by the fact that we've moved our innovative portfolio forward, and we've sold that particularly well, commercialized it really well in the United States, Austedo, Uzedy, and Ajovy. And those have performed tremendously well. We've raised our consensus twice in the year because of their performance. And then towards the end of the year, our pipeline started to mature, and we saw some great data on our TL1A. And that was sort of, I think really surprised everybody. And so with all that, we had a great 24. And in a way, to be a little bit boring, it's going to be more of the same in 25. We're going to keep driving Austedo, keep driving Uzedy, keep driving Ajovy, and bring that pipeline through. Because now people are really excited about the innovative aspects of Teva and our pipeline. We'll still do that. And on our generics and biosimilars, keep driving that. That's been a consistent driver for us and throwing off cash that allows us to invest in that innovative business, which is creating so much excitement.
Well, in your case, more of the same is good. I'm sure your shareholders would be happy to see a repeat performance there. But I want to talk a little bit about generic drugs and particularly prices, because prices for generics still going down in the U.S. And I believe you said on your latest earnings call that you expect generic prices to be pushed down further in 2025. So against that backdrop, I mean, how do you sustain the generics business in that deflationary environment?
Well, I think for generics, you've got to have a few things. You've got to be global in scale, and we are. You've got to have a really deep pipeline, which we do, great manufacturing capability, which we do, and then a go-to-market model, which we have that global reach. But we have to do all of those three things really consistently. I do think, there comes a point where as much as we can offset those price decreases and keep growing the company, I do think healthcare systems in the United States and Europe need to understand, are they paying the right amount for what are high-quality medicines? I think Teva supplies roughly 1 in 10, 1 in 12 scripts in the United States. So every 10 or 12 scripts is a Teva script. And I'm very proud of that because we help, affordable medicines, people have access to affordable medicines. But despite our efficiency and our scale, then I do think potentially we have to really think about that if we want to have that level of service and not to have any issues with supply.
Well, let's get into some supply questions here. I want to talk about Adderall because you have both brand name and generic Adderall in a shortage since 2022, which of course you manufacture. What more can be done to end the shortage, and what role do you think that the government and other companies should be playing here?
Yeah, I think this is an interesting one because there's been a sort of dramatic increase in the prescriptions of this product. And so because of the type of product it is, we're given a quota by the government for what we can make. And so we make that amount and we max out on that amount because it's a restricted substance. And so it's quite a complex supply chain. I think part of it is about assessing, is this about supply or is this about prescriptions and is this about overprescribing? And I think that's the area that needs to be looked at. But we're maxed out on what we're being asked to do and we're committed to do that. So I think it's a bigger, more complex story.
Two questions there, I guess. Would you expect that, that ceiling on what you can make to move higher? And then what is your opinion? Do you think that this is an issue of supply or overprescription?
That's a really good question. I mean, I think it's one where when I look at it comparative to other markets, then the usage and the supply is a lot higher in the United States. So we don't often see discrepancies on a geographical scale like that. So I think it's probably something that as people investigate it, and I think the government should look into it and the FDA, I think it maybe is a bit of both. But I think the supply is probably where it should be, maybe needs a bit more. I think the prescriptions has really accelerated dramatically, and we've got to ask why. Is that a change in the incidence, the epidemiology? I'm not so sure.
Yeah, that's a big question when it comes to overprescribing that I won't ask you that particularly, but I do want to talk about GLP-1s because you came out with your first generic GLP-1 drug. It's a copy of one of Novo Nordisk's lineup. What are your plans for selling generics of the more popular GLP-1s that are out there?
So we plan to do it. So we have that one, Victoza, that came out last year, and this year we plan to launch Saxenda, so it's another GLP-1. And our aim is to, as a global generics company, any product that loses its patent, we sort of have in our line of sight. And obviously the bigger ones, we definitely have in our line of sight. So all those GLP-1s and those emerging other modalities in obesity, we would target. But we always think about capital allocation. because as much as we're a $9 billion generics business, we're also one of the fastest growing innovative companies. And so capital allocation is very important. And so we're still putting the majority of our capital into our innovative business because we have such a deep pipeline and such an exciting pipeline that we want to make sure that's properly resourced.
Well, to that point of capital allocation, let's talk about the M&A outlook here, because we're at the JP Morgan Healthcare Conference. We are being hit over the head with deal announcements, and you're expected to see a more friendly regulatory environment, at least in the United States, under the second Trump administration. What is your strategy when it comes to M&A right now?
Yeah, so we're sort of one, our balance sheet allows us to do a certain amount, so I don't think you're going to see us go big. We're probably going to in-license a lot of, look to in-license products. But the thing we have is, because we have this pipeline that I keep talking about, late stage, we have a product, Dari in asthma in phase 3, we have olanzapine in phase 3 for schizophrenia, and we have the TL1A, which everybody's excited about at the end of last year in phase 2, now moving to phase 3. So we have a lot of growth drivers coming forward in Teva. So, and then we have other products that we've moved into phase 2, Emrisolmin for MSA, a rare disease. So we have quite a lot in our pipeline. So when we think about BD or M&A, we've got to think carefully, because we can allocate a lot of capital to our own pipeline and I think give a good return for our shareholders. And so when we look outside, we just got to be mindful, is it worth bringing that in, or do we have a pipeline? And that's a challenge we always have in our industry. But I think we're in a particular privileged position with Teva because of the pipeline we have. But we'll aim to do some more in licensing than big M&A.
All right, well, that's a good place to leave it. Richard, really appreciate you taking the time.
Thanks, Katie. Pleasure to be here.
All right, back to you, New York.
Katie, thanks very much. Katie Greifeld there, and she'll continue to interview CEOs from the JP Morgan Healthcare Conference in San Francisco. I have breaking news on U.S. Steel. The stock is jumping after a report that Cleveland-Cliffs is partnering with Nucor to make a bid for the company. All of those stocks in the green, but notably U.S. Steel up the most, now trading up 8% at $37 a share. Sonali, this was a stock that had traded over the last year, at one point, more than $42 a share, when there was more optimism that Nippon Steel from Japan would come in to buy it. It became a huge issue during the election. Both Kamala and Donald Trump saying, no way are they going to let a Japanese company come in and buy U.S. Steel.
And of course, the Biden administration finally putting the nail in the coffin on that deal. But you have now CNBC reporting that what this would look like is an offer in the high $30 a share. That's certainly where now you have the stock trading just under $37. And to your point, this was a stock that in 2023 was almost $50. So you could call it a steal. Nucor, according to the report, would be buying the Big River Steel subsidiary. So then Cleveland-Cliffs would take the rest. Remember, Cleveland-Cliffs earlier in the process did try to make an offer here and get involved. And you could tell now that if he does, he will be doing it at quite the steal.
All right. Yeah. Interesting story. I like that.
Didn't do that one on purpose.
Not intended. Yeah, so we'll continue to follow U.S. Steel for you and the potential of an American buyer, white knight, if you will. We'll continue to follow these markets for you, which are down at the S&P 500, currently off 0.7%. This is Bloomberg.
And it's time now for the Wall Street Beat. Today we are looking at bank earnings to come this week because they are going to come in hot and heavy starting Wednesday morning. JP Morgan, Citigroup, Wells Fargo, and Goldman Sachs. And then Thursday we have Morgan Stanley and Bank of America. And a few things here, Matt. When we look at the way that the financials have performed, it is often those bread and butter investment banks with the return of deals that have been doing so well. Morgan Stanley, JP Morgan, Goldman, and Citi in particular. But you do have a bit in some of the regional banks as well. And in fact, very few of the regional banks in the KBW Bank Index have been underperforming. You take a look, for example, at First Horizon, up 22% just over the past 3 months alone. You have the same for others, like Zion's, up 7%. So you're not seeing it outpace the S&P, but still there's hope there.
Yeah, I have questions as to especially some of the regional banks on the West Coast. How exposed are they to this fire damage that we're seeing? And then, going back to the big ones, Goldman Sachs putting together a new unit that we're going to talk about later on in the program.
Yeah, this capital solutions business, of course, that's a recognition that right now companies are looking for money from everywhere. That includes the private markets. Going to be a big part of that comeback story. Now, coming up in the next hour, we're going to speak with Eli Lilly CEO, joining Katie to discuss the obesity drug shortage, health insurance, and more. Stick with us for that conversation. From JP Morgan, this is Bloomberg.
We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Sonali Basak. Katie Greifeld is on assignment in San Francisco. And coming up, LA faces a second week of fierce winds as economic losses pile up, now estimated at $275 billion and climbing. And markets are on edge as traders are bracing for the latest inflation reads this week. Meanwhile, Nvidia takes a nosedive on a report that some of its top customers are pulling back orders on some Blackwell chips. And J&J announcing the biggest biotech deal in over a year. You can see both stocks on the up and up. We're going to take you live to the JP Morgan Healthcare Conference in San Francisco, where our own Katie Greifeld is sitting down with the CEO of Eli Lilly in just a few moments.
First off, let's get a check on what's going on in the markets. In terms of equities, we're not at session lows here. S&P 500 currently down 0.5%. And the NASDAQ down a little bit more than 1%. Nvidia is a big weight on those indexes, as Sonali just said. There's a report out in the information that some of the biggest customers of Nvidia, Meta, AWS, Microsoft, are all pulling back on orders for Blackwell chip racks. And obviously, that's not great news compared to the other press release NVIDIA put out today that they're going to be in a tie-up with the Mayo Clinic and Illumina. By the way, Katie will be talking to the CEO of Illumina tomorrow from the JP Morgan Healthcare Conference in San Francisco. So I think that's one that's interesting to pay attention to. And right now, we're going to go back to that conference because Katie is sitting down with Dave Ricks from Eli Lilly. Katie?
All right, thank you, guys. Yes, I'm sitting down now with the CEO of Eli Lilly, Dave Ricks. It's great to see you in person, Dave.
Great to be with you, Katie.
Let's start with the news that you have out this morning, and that is that Eli Lilly is buying Scorpion Therapeutics' breast cancer program for up to $2.5 billion. And I'll start with the basics. Why this deal and why now?
Yeah, well, it fits in really well with what we're doing in breast cancer, which is changing the lives for so many people who suffer from that condition. Of course, Verzenio is our leading product in that space. This is a targeted therapy for a specific mutation in breast cancer. It affects 30 to 40% of women with breast cancer. And Scorpion's developed this program through phase 2. It's a big phase 3 program to do to get this to market. And so it's a great transaction for both sides, and it adds to what we're doing. We also have another oral medication for breast cancer coming. We read out data last year. So a growing cluster of medicines there to really help people live longer with breast cancer. It's an exciting deal for us, and we're pleased to work with Scorpion to bring it in-house.
Yeah, and this deal was really interesting because it's a nice reminder that, of course, Eli Lilly does more than just weight loss. So give us some context on the overall portfolio here, how the oncology fits with, of course, weight loss and everything else that you do. Yeah,
well, we have 4 therapeutic areas, and of course, diabetes and weight loss has been the story all of last year, and that it's exciting because it's growing and big, but that's about 40% of the company. The other 60% is also doing incredibly well. Breast cancer, we mentioned in oncology here. We have other oncology assets, including for hematology, that are in the market and doing great. Immunology is another important area for us, and products like Ebglyss for atopic dermatitis, which just launched in Q4, along with Taltz for psoriasis. And then neuroscience. Alzheimer's launched last year in the fourth quarter, and we're ramping that now. So the company's got a broad portfolio. We want to work on medicines for terrible diseases of all kinds, not just obesity, but of course the obesity story is exciting and broad as well.
And before we get into some of the specific areas there, when it comes to M&A, obviously there is a ton of optimism as it relates to the M&A environment under a second Trump administration. What is your M&A strategy? Where are there more opportunities for inorganic growth?
Yeah, well, we've been very consistent, and it's working for us. The motion for us is to go early and stay in our lane, basically. So focus on the therapeutic areas where we know a lot. That makes us a smart buyer. And by going early, we take more risk, but do smaller deals. You know, I know there's been a lot of talk about M&A under the Biden administration and how hard it's been, but for us, not so much. We've done 100 deals in the last 3 years. That's the most in biopharma, but a lot of them are small, below the radar, but it builds that early stage pipeline strength for us. And Lilly may be in a little different position because our near-term outlook, maybe our midterm outlook, is so strong. We don't need to plug a sales gap. We're just trying to find assets where we can add value and create great medicines for patients. This deal with Scorpion's another example of that.
Yeah, and a great point, too, about flying under the radar there with those bite-sized deals. Let's get to GLP-1s, of course. There's a lot of anticipation and excitement around your oral weight loss drug, of course. There's some forthcoming data. And if that trial, in particular, is successful, how long do you think it would take to get approval here?
Yeah, so a lot of developments going on in our incretin portfolio. Orforglipron is the name of the medicine.
I'm going to practice.
Yeah, it's hard. I had to practice too. And we should get data before the middle of the year, the first set of studies. It's highly anticipated and really important. One, because it's convenient, it could be an oral pill. Two, efficacy point. Is it as good as Ozempic, essentially, or semaglutide? That's the goal for us, and as tolerable. If it is, it could be approved in early 26. And the benefit here is not just the convenience of the pill, but the ability to scale it. We all know the production systems for injectables have really been stretched, and we continue to build sites and so forth. But with the oral technology, we can make more and get this medicine to more people around the world. And I think that's an exciting development for the company if the data is positive.
And I know my co-anchor in New York, Matt Miller, is listening very closely right now. He would tell you himself he'd like to get in one of these trials. But when we get...
Have him call me. Yeah.
Well, when we get to the approval stage, I mean, what do you see as the dynamic between the oral medications and the injectables? How much of the market do you see the orals potentially taking?
Well, I think we'll see over the next 3 years fragmentation in, as you see in any scaled market. Right now, total incretins in the world are probably exiting, 40 to 50 billion. And so that's a big market in pharma, and it likely is going well north of that. And so we'll expect people to carve out niches. One niche is medicalization. So, for instance, at the end of last year, Zepbound or Mounjaro showed success in sleep apnea. So here's like a targeted condition, like 10 million Americans, and it's the only drug approved in that space. So people with that condition will seek the medication. We have also people who just want to lose weight for general health. So that's a broad-based. And then, products like coming like our triple-acting incretin, retatrutide, which is in phase 3 studies now, will likely be segmented toward more the people who need to lose more weight. So their BMIs are over 35. They have more to lose. So I think you'll see new medicines come out covering different segments of this very large and growing market. And the oral likely serves that sort of first-line, broad-based need, and that's great because we can produce a lot of it. It also will be an important medicine for middle-income markets like China and Brazil, where there is, India, lots of obesity, but we just can't get enough of our product there at the right price point right now because the injectable systems are expensive and hard to scale.
Well, let's talk a little bit more about pricing here. And I know that it's early, you're still in trials, but if approved, would you expect that the orals would be priced cheaper than Zepbound?
Well, I mean, we priced Zepbound cheaper than semaglutide when we launched, and it's a better product. We've proven that. You lose almost 50% more weight. When we do pricing, of course, the value in the actual clinical data is very important, so we'll have to see that. But also, we need to think about this segmentation we just discussed. So more to come on pricing. We're not going to announce it today. We need to first get the phase 3 study done. But our goal will be to reach the masses with that product, and so we need a pricing strategy in concert with that.
Well, I tried on the pricing, but...
Well, I'll come back on your show and we'll talk about it. Yeah.
I will follow up with you on that. But let's talk a little bit about politics here. And of course, the incoming president, Donald Trump, you met with him recently. When it comes to the new administration, what sort of pricing policies are you potentially anticipating there?
Yeah, I mean, it's a good question. We are still waiting for them to be seated, inauguration next week, and the confirmations, et cetera. I would say first that this idea of incoming administration that's focused on the health of Americans is one that excites us. And there's a lot of common cause with the pharma industry and Lilly. we wake up every day trying to make America healthy again. So if that's the goal, we have common interests. How that happens, we need to learn more what the strategies are. But of course, for instance, with our Zepbound, I mean, what a great tool to really improve the overall health of America. So we'll seek partnerships with them to say, how can we expand access? How can we get new medicines like orforglipron approved faster? How can we improve insurance coverage and reduce costs for Americans? Those are all topics we want to engage on. And they also want to make the system work better. I think the president's talked about the role of the middlemen. And of course, we need a way to get our drugs to patients. But the way the system's set up, like so many things in healthcare, is too complicated and non-transparent. And so we support those kinds of changes as well.
You said make America healthy again, so I have to bring up RFK Jr.
Yeah.
Have you met with him?
He was at the dinner. I think that was widely reported. Yeah, yeah.
Okay.
So, and we talked about where's the common ground.
Okay.
I mean, we are focused on people who want to get healthy, so we have a lot in common there. Yeah.
I want to go back to Alzheimer's.
Yeah.
We were talking a little bit in the commercial break about it, and in the context of Eli Lilly being more than just weight loss drugs, your Alzheimer's treatment received FDA clearance in July of 2024. What indications can you give us about adoption so far?
Yeah, and it's so exciting for us because we've spent so much time, like 30 years, working to get a medicine approved. It's been very difficult. We launched in September. We make a number of the diagnostics, and the good news is we see a lot of people seeking answers to the question, if I have dementia symptoms, do I also have amyloid, and am I a candidate for the medicine? So that's growing pretty rapidly right now. And then Kisunla, our brand, we're seeing utilization start to ramp, particularly in December. So that's good news. And we're not done there yet. I think there's studies to read out ahead, maybe late this year, early next year, in Alzheimer's prevention, which is, I think, a much better answer. Why wait till you get the dementia symptoms? Let's prevent it if you have amyloid, excess amyloid in your brain. And then more broadly, I think for viewers interesting, I am super bullish on neurodegeneration as a category we can address with medicines. And those are the scariest conditions we think about: Parkinson's, ALS, Alzheimer's. I think there's more medicines coming in Alzheimer's and more medicines coming in these other conditions, hopefully from Lilly. But that's an area where science is moving rapidly, and Lilly's at the forefront.
Well, Dave, I so enjoyed this conversation. Hope to speak to you again soon. That, of course, is Eli Lilly's CEO, Dave Ricks.
Thanks,
Back
Katie.
to you, Sonali.
Katie, looking forward to the rest of your interviews. Of course, that was Katie Greifeld with Eli Lilly CEO Dave Ricks. Certainly the man of the hour in a lot of ways with what's happening in GLP-1s, but also he's speaking about the potential for more treatments when it comes to Parkinson's, what's possible when it comes to Alzheimer's, dementia. Certainly a lot of people looking to crack the code there. In addition to all that, deals.
Yeah.
Healthcare, you're seeing one after another in terms of mergers and acquisitions.
Well, and working with the next administration. I think that'll be key. We've seen a lot of progress so far in terms of price negotiations. I'm not sure how much Dave wants to be on the other side of the table from a negotiator in terms of Medicare and Medicaid, but it'll be interesting to see what the incoming Trump administration does, as well as, if he is confirmed, RFK Jr.
We're going to talk about that more later in this program. We're also going to talk mostly next about NVIDIA, because it's been lagging big time this morning after a report that some of the customers are facing delays, big customers too, related to the company's newest chips. We're going to take a deeper dive next into what exactly is happening in big tech and AI. This is Bloomberg.
Let's get out of high interest to look at what's making headlines around the world. Bill Ackman's Pershing Square Capital is proposing a deal to merge one of its subsidiaries with real estate company Howard Hughes Holdings. It's Ackman's latest step in the pursuit of the real estate developer he used to help lead. Ackman says he would try to turn Howard Hughes, known for its investments in master planned communities, into a modern day Berkshire Hathaway. And a significant milestone for Tesla as the EV maker overtakes Audi in global car sales for the first time. That's even though the company said it sold fewer vehicles than had been expected last year and fewer than the year prior. Audi sold way fewer. It is, of course, owned by Volkswagen. It saw an annual sales slump of 12% due to intensifying competition in Europe and China. And Blue Origin And Jeff Bezos, Blue Origin is backed by Jeff Bezos, suffered a setback after it delayed the inaugural launch of its new flagship rocket this morning because of an unspecified issue. Bezos is mounting a challenge to Elon Musk's SpaceX, and the billionaire told Bloomberg that the space industry has room for multiple winners. Sonali?
We're going to stay in the tech industry here because NVIDIA is sinking this morning, especially after a report that some of their top customers are facing delays in getting their new Blackwell chips up and running. Here with more, Bloomberg Technology co-host Caroline Hyde. You are seeing NVIDIA pairing some of those losses. I will say what Matt likes to say. Things are running, how? Too hot. I can't do it like that. But, you know, that's the problem here, isn't it? It's actually the heat of what's happening in the data centers that are keeping customers from being able to operate at scale.
GB200, the racks that they go inside, need liquid cooling. It is incredibly complex to help these chips work efficiently with each other and indeed keep them at the right temperature. The scale of innovation that NVIDIA delivers, yes, the chips are great, but then you've got to present them. Foxconn helps with that, Dell, Supermicro, but all of this comes with a lot of innovation on the supplier side of things too. And NVIDIA has tried to sell itself as a one-stop shop. Come to us, not just for the chips, but for the entire infrastructure. But now we're starting to see at the moment, look, time and time again, there's going to be some issues here. Delays. It's probably not going to lose them money in the longer term, but in the short term, we're going to see that Blackwell run rate hit in the first half of the year as had been anticipated. And what of Microsoft, Meta, Amazon? Will their frustrations just build and they're going to ever more try to search for different suppliers? I will add, there's also the overhang of the fact that the White House is imposing yet further curbs on the exports of NVIDIA chips to other countries, and that's going to be a weight on the stock today too.
Right. I mean, if you take a look at the Bloomberg function SPLC on NVIDIA.
A favorite.
It is one of my favorite functions. You can see that these companies, the information reported, are pulling back on their orders, are some of the biggest customers anyway. Microsoft, Meta, Alphabet, Amazon. Zoom over to the side where the customers are sitting and you'll see those names. It's not unexpected that these would be the ones reducing orders. They're the ones with all the orders in the first place, right?
Exactly. And there were reports by the information again that, Microsoft, Amazon, Google, Meta have put in about $10 billion worth of orders in each for the latest and greatest in Blackwell. But remember, the hopper's still on offer. And yes, it's a less energy efficient chip, but it's still good. And so many of them are just saying, hold on, we want to wait until the next rack innovation is there. We want to ensure that the energy efficiency is there that you're promising. We'll just hold on and reorientate towards the older set of chips. In particular, the information reporting that's what Microsoft has done to ensure that OpenAI is getting the computing power that it needs right here, right now into Phoenix. But as you say, the ripple effects here, Sonali, are so broad because it's not just whether it falls in NVIDIA's first half or second half revenue. It's whether or not OpenAI, whether or not the latest and greatest large language model makers and appliers can make the most of it, can actually get the energy and compute that they need.
Everything you're saying sounds extraordinarily expensive.
Yes.
And would require, therefore, capital to get it all done for the large companies that NVIDIA, to your point, supplies to. If you look at the Magnificent 7 price return index right now, you actually have 5 out of 7 stocks in the red on the year so far. If you have that kind of negative sentiment coming into markets a little bit, then how much extra room do these companies have to make gangbusters investments this year? Does that start to have a ripple effect?
They've got so much money and they have got so many profits that I think they're still able to commit to the R&D side. It's whether or not the investors are going to be a little bit concerned about the profit for the long term. I haven't heard a single investor say, go short or start to reduce out of NVIDIA. You still got more than 70 buys on this stock. People still think in the longer term this is a company to deliver. But you're right, perhaps we're not going to see a 200% increase in the share price that we saw this time we saw for the 2024 outlook. But it's interesting, we're all talking about capital and spend and what's happening with like a profitability of an Apple as well. Look, there's one of the biggest market moving news today was, of course, Apple and whether or not the iPhones are selling as well as they had been anticipated to. That's all about Apple Intelligence. That's all about getting OpenAI, ChatGPT within the offering. And is the innovation going to be keeping up to a pace if they can't get hold of the infrastructure that's necessary?
It's amazing. I just look at the ANR function, and
Analyst recommendation.
70 buys.
Extraordinary.
0 sells on this. I don't think you make money selling NVIDIA, but there are 8 holds, which I think is pretty interesting. Carolyn, hi, great to have you on the program.
So fun.
Look forward to watching you anchor Bloomberg Tech. That starts at 11 a.m. I was looking at the inflation data, worried about what's going to come out tomorrow and Wednesday. This morning I said, we need an economist. And they said, we got you Joe Lavorgna. I'm very excited to say he's coming on next. This is Bloomberg. Let's get a check on what's going on in the markets right now. You can see red on the board. The S&P 500 down another 0.75% after the more than 1% drop that we saw on Friday. Stocks are now trading at below the level they were below the closing level on November 5th. So we've erased the entire Trump bump, if you want to call it that, as we get really good economic news, right? Jobs added 256,000, and that pushed rates up to almost 4.8%.
Yeah, but this time investors are not saying that strong economy is good if rates keep going that much higher. You're looking at the 10-year back closer again to that 4.8% level. See if we end there. Coming up, we're going to talk about Republicans calling their talks with Trump positive as they look to raise or eliminate the SALT cap, Matt's favorite thing.
House Republicans are said to be optimistic after face-to-face meetings with President-elect Trump over the weekend. Discussions were focused on the state and local tax deductions. Lawmakers are aiming to raise the $10,000 cap that President Trump and lawmakers originally put on us in 2017. The SALT deductions are set to expire after 2025. Joining us with more is Nathan Dean of Bloomberg Intelligence. Nathan, I would imagine President Trump is on board with removing the cap, as he said to voters when he was campaigning in Long Island that he would get rid of it. So what's the holdup?
Well, the holdup is that, for these tax extensions, it's going to cost around $4 to $4.5 trillion to pay for them. And you got to figure out how to get that number close. And the SALT deduction, if you will, is an easy way for the majority of politicians around the United States to say, look, let's pay for the tax extensions for all to the detriment of those of you in New York and New Jersey. Now, when this salty caucus, if you will, what they're calling around here in Washington, met with President Trump, one of the ideas was going from 10,000 to 20,000. That's what President Trump, I think, is on board with at the moment, but certainly not the 100,000 or elimination of the cap that the folks from New York and New Jersey certainly want. Now, as these negotiations take place and as we get closer to an idea of where the tax extension bill will look like, we'll see how the SALT deduction plays into that. But when you can only lose 3 to 5 votes on the Republican side, and there are going to be no Democratic votes as part of this process, it's going to be very difficult to figure out how to increase that cap for the folks in New York, but also pay for the tax extensions for the rest of America.
Right. Even if you put away the math for a moment here, what is going to be more politically favorable?
So I think politically favorable is to have those tax extensions continue. I mean, I apologize again to those of you in New York and New Jersey and Connecticut, but there are a lot of lawmakers across the United States that use this as an easy way to pay for. Paying for $4.5 trillion of tax extensions is not going to be easy. There's been a lot of talk about gutting the IRA, the Inflation Reduction, if you will, Inflation Reduction Act. That's only $433 billion. That's not all that much. So the SALT deduction in particular is an easy pay for. It's an easy way for folks to say, Oklahoma, look, I need to get your tax extensions going. It's the folks up in the wealthy up in New York that are going to be paying for it. It's an easy sell for them. So, we do anticipate President Trump is going to give some SALT relief. They're calling it a taste of SALT, if you will. But I don't think you're going to get to the scenario where the cap is gone in its entirety or it's eliminated.
All right, Nathan, thanks so much. Nathan Dean there of Bloomberg Intelligence. He has all the intel when it comes to what's going on in Washington, and I think a lot of our clients really rely on him for stuff like this. Let's talk a little bit more about the SALT tax cap and really the broader economy after that blowout jobs number that we had on Friday. Joe Lavorgna joins us right now. He is the SMB Nikko Securities America chief U.S. economist. He was White House National Economic Council chief economist in the last Trump administration. Great to have you here on set with us, Joe.
Great to be here.
Before we get to the other stuff, and I know SALT is pretty narrow, but a lot of our viewers are living in New York, New Jersey, California, and concerned and Connecticut concerned about this. What do you think the chances are that President Trump, as he promised to voters, is going to be able to get rid of the cap that he put on?
Certainly raising the cap, perhaps this by a significant amount. I think Congressman Lawler said he wanted something well above 20,000. There'll be some SALT package. My guess is there'll be some SALT deal in the budget reconciliation bill that gets done later this year, whether it's a total removal or just raising it from 10 to something meaningfully above that. My best guess, personally, is that it's probably just a lifting of the cap, not a complete reversal. In general, though, it doesn't cost a lot of money. And while I was listening to Nathan's comments earlier, the one thing I take big issue with, just broadly speaking, is the CBO scoring of the extension of the tax cuts is $4 trillion plus or whatever the number is. That makes no sense because we already have current tax policy. We've had this policy in place for 7 years. And if you look back at what CBO scored the TICJA at, the Tax Cuts and Jobs Act, in the spring of 17, we're about $1.5 trillion more than what they had expected. The revenue share of GDP is in line to above its historical average. So this notion some other going to have these huge tax hikes coming in 26, and it's going to generate $4 trillion plus monies that you would otherwise have had makes no economic sense whatsoever. And I would also implore the CBO to do more dynamic scoring because they don't do a good job on that.
Well, let's talk about that in light of the huge jobs number that we got on Friday, because I think the two things are related in that they affect, Trump's election and the Tax Cuts and Jobs Act affect small business confidence, right? We got 256,000 jobs added. And I know that you'll say a lot of that comes down to the election results. There's more confidence in a Trump administration, and so they're hiring. The same is true if you cut their taxes, right? They're more likely to spend that money on things like employees.
Right, yeah. So, I would think, look, obviously, I work with President Trump, and if you looked at the small business data back under his term, it was never higher than under any administration, Republican or Democrat. So when you're talking about lower corporate tax rates and, importantly, much less regulation and the potential for much lower energy costs, that's positive news. We saw small business sentiment really jump following the election. The biggest jump in the history of the data goes back to the 1980s. And we actually have the data out tomorrow. So I think we're still going to see very positive optimism. And that, to me, was part of the December employment report, because companies that may have been on the fence or weren't sure as they're doing their year ahead planning and et cetera, hired extra people. So I've argued that the job market recently hasn't looked great if you take private jobs and you take out health care. But when you do that this month or the last month, you're about 155,000 jobs. So that's a good sign. If the trend should continue, if President Trump can get his legislative agenda through, it should be very positive for small businesses. Small businesses account for 40% of hiring. What's interesting to me is what the Fed does, because the Fed, to me, is really, given the current administration, a real messy handoff.
Notwithstanding what we're seeing in terms of the economic data, and we have a lot more ahead this week, I know we're going to want to talk about it, we're also kind of reaching that danger zone. You had Secretary Yellen come out and say that you'd hit that debt limit by January 14th to January 23rd. That's tomorrow where that window begins. How are folks in Washington and investors thinking about that in the midst of all of this uncertainty?
A problem that I have is that the Treasury Secretary increased bill supply to roughly 22%. This is by late 23 of all marketable issuance. Bond Market Association recommends something much less, 15 to 20. Now, with the debt ceiling becoming a problem because we've had such massive deficits, the Treasury tends to increase bill supply in these environments. So you got even now a ramp up in bill supply. And that's making the market understandably nervous about coupon issuance eventually going much higher, because the fact is the Treasury Secretary, current Treasury Secretary, could have termed out significant amounts of debt when rates are at all-time record lows and chose not to do this. That's a mistake. So the market now is worried that you're going to get more long-term supply, and that's what's causing, in part, this rise in interest rates. This increase in term premium that we've been seeing is partly a supply story concern.
We just pulled up a chart of inflation expectations and the Fed. You mentioned that what the Fed does is very important here. Doesn't the Fed have to prepare for higher inflation expectations if we get, tax cuts, deregulation, and especially tariffs and mass deportations?
No. We've had inflation break even rise about 40 basis points from where it was back in September, but then it was falling because people worried, given the labor data at the time, the economy was really weakening. I could have justified the 50 basis point cut. And I argued the Fed should do 50, and they did. But they shouldn't have moved in November and in December. What we have now is a Fed that raised its growth forecast, raised its inflation forecast, still cut interest rates in December, and still kept a couple of cuts in place for this year. That was, I think, really economically imprudent. So if there is a future inflation expectation story, I'd put that on the Fed. And by the way, this horrendous situation in California, that's going to lead to massive increase in costs for commodities, construction workers rebuilding. And here you've got the Fed that itself, if anybody's losing inflation credibility, it's the Fed. And to me, that's also part of this term premium rise in the market. Maybe the Fed isn't doing as good a job as people thought.
What's the upper bound? We keep on asking this because when we talk about term premium and we worry about the fiscal situation of the United States and then layer on inflation on top of that with all of these uncertainties, by the way, it would be a very large federal expense at the end of the day, too, with what's happening in California, notwithstanding any other potential future shocks that we might see. Where do we go from here in terms of what investors will demand to be paid for longer-term U.S. maturities?
Outside of with the exception of the U.K., the U.S. is the highest yielding market in the world. And as interest rates have risen, the dollar has strengthened. The dollar will provide some of an offset. Fundamentally, I think inflation is going to be lower. I think the economists have totally missed, not all, but many have missed this tariff story. I don't think it's going to be inflation under Trump. But anyway, be that as it may, you've got high yields in the U.S. that's lift the dollar. If we make a move to 5%, financial conditions are going to tighten a lot more. That's going to impact equity market further, which is what we're seeing. We're seeing credit spreads widen. 5%, I don't want to say that's a line in the sand, but 5% is kind of the very high end, I think, is economically plausible. And then if we get the Trump agenda in place and inflation comes down in the back half of the year, we estimate fair value on 10-year notes between 4 and 4.25. So I think we're at that point now where the fulcrum really has probably moved too much in the pessimistic side. But given the supply that's still coming in February, the fact seasonally this is the time of the year we issue the most amount of bonds, I can see why the market's doing what it's doing, but I don't think it's going to last.
Joe, great to get your view. Really appreciate you coming in and talking to us. Joe Lavorgna there from SMBC, Nikko Securities, and of course the first Trump White House. Coming up, Los Angeles bracing for another week of uncertainty in what is already set to be one of the costliest natural disasters in U.S. history. We'll bring you the latest on the wildfires next. This is Bloomberg.
Now, LA is bracing for more wildfires early this week as the Santa Ana winds return. AccuWeather has now raised its estimate for wildfire damages and economic losses to between $250 billion to $275 billion. The previous estimate was $135 billion to $150 billion. Bloomberg Intelligence anticipates the Palisades fire will likely be the highest insured fire loss ever. And joining us now, Bloomberg Intelligence senior insurance analyst Matthew Palazzola. Even if this were to be the highest insured loss, the unfortunate aspect of this is that the insured losses are a very small portion in reality of the total addressable losses from what we're seeing. This is infrastructure damage. These are homes and other buildings. What does this mean for California's FAIR plan? Because that is where a lot of excess capacity is. Now the solvency, as your team has written, is in doubt. So what do they do?
So you're already seeing it. The state is already trying to, on the fly, enact some changes in the FAIR plan. The FAIR plan will not have enough money, in my view, to pay these claims. This speaks to a broader problem in the market that the FAIR plan has to even exist in the first place. The FAIR plan just recently upped limits on some policies and then couldn't get price increases to account for them. So I think we end up seeing the state step in more. They make a point to say it's not taxpayer funded, but I do think in the end it's going to ultimately end up costing consumers more.
Well, that was my question. How do they raise more money? You had also written that the California Infrastructure and Economic Development Bank may go out and look to tap capital markets, maybe look to issue bonds. Would investors take on this risk?
Yeah, I mean, it doesn't seem like a great risk. Like, if you look at this residual market pool, they had about $700 million in cash $200 million in surplus and $2.5 billion in reinsurance. In the state, they have about $400 billion of risk. So you're looking at that capital versus, of course, that's the entire state, but you're still looking at that level of risk versus that level of capital. So the state is enacting this plan for bonds. They're also allowing the FAIR Plan to access lines of credit. I think ultimately the capital comes from the state, though.
Right. Well, I mean, the FAIR Plan is the kind of thing that you expect to be subsidized by the state and really by the federal government. So it doesn't matter as much to us as the publicly traded insurers. What kind of losses are they facing? What have you seen the share prices do? And do you think, you know, in the case of those that have seen declines, we've overreacted?
Yeah, I mean, I think we did. And you actually see these stocks coming back a bit today.
We're talking about Allstate. We're talking about Chubb.
Allstate, Chubb, Progressive specifically. Progressive might still be down today, but some of these stocks, you look at the market move and I say, okay, so you're taking $4 billion of market cap out of Chubb. They're not going to have $4 billion worth of losses out of this event. So I think the initial reaction was probably too steep. You're seeing some of those names come back. In our scenario analysis we're running, it seems like an earnings event in the first quarter. It's not going to be a capital event for these large national insurance companies.
Are they going to have to raise premiums? I mean, is this how it goes? You have a big catastrophe, they pay out, but they raise premiums, so it ends up costing everyone more in the longer term.
I think the dynamics in California are going to be higher prices anyway. So it's kind of usually the way it works, right? That they will come in and raise prices after these things happen. So certainly if you had a large loss, it's going to be tougher for you to get insurance. I think premiums go up in the state. The different state dynamics will be different. So I don't think they dramatically raise prices everywhere to account for this, but certainly in California.
And there's always going to be some kind of fair system, some kind of government-backed way to insure things that most people can't afford to.
The problem, Matt, is that insurance is regulated on a state-by-state basis. In some cases, it's an elected insurance commissioner, like in California. So you've got this kind of interplay of politics and affordability. So we're trying to make everyone happy, and they kind of end up spreading the cost.
Matthew, we thank you so much for joining us. That is Matthew Palazzolo of Bloomberg Intelligence on a really complicated situation and a very sad one out in Los Angeles. Stick with us. More markets ahead. This is Bloomberg. And it's time now for the Wall Street Beat. Today, we're focusing on changes at Goldman Sachs. The bank is promoting several key executives and combining some teams as it forms a new capital solutions group, which is kind of the new hot thing to be doing on Wall Street. We'll talk about why now with Bloomberg's U.S. finance reporter Todd Gillespie, who now also covers Goldman Sachs. So congratulations for the expansion of your role there. Something that's interesting to me about this specific situation, you have Goldman Sachs with an investment bank that deals with raising money for clients, and then you also have their asset manager diving deeper into private credit. How much of this is a recognition that you have to include more private credit when you're thinking about financing of regular way companies?
Certainly. It's all about, making sure that the bank is maintaining its relevance, right? The traditional banks, the traditional financing sector across Wall Street, they're all really dealing with these emerging challenges, from the Blackstones to KKRs. But they already have, access to public markets. They already have access to private markets through their asset management arms. And really, part of this move is about making sure that those teams are working more closely together, making sure that the bank can leverage its existing opportunities, existing contacts, and adding to this one Goldman Sachs ideal that the bank is, has long talked about, right?
And they've long worked together as well. Pete Lyon, the global head of financing institutions, that group, and Mahesh Sareddy, global head of mortgages and structured products. They're going to get together and lead this new combined financing team.
By the way, this is what John Waldron, the president, and David Solomon really did before they even rose to the very top. So much of it is in their DNA.
Well, it's just interesting also to see these men move up and take over this business. But I think the most important issue is what Sonali stated at the top, and what we're seeing in these big Wall Street banks is they're trying to claw back some of the ground they've lost in private credit to companies like Blue Owl. How successful are they, and is Goldman Sachs specifically making some headway there?
Yeah, I mean, that's certainly a huge part of this. It's a huge recognition of that wave. Their asset management business and private credit is growing, very substantially at the same time, as they're also just trying to work out how to integrate this with more traditional types of lending, both looking at origination and also looking at the kinds of products that they can offer, to their clients across the board, and not just going down a one-track, mind, in these different units. But crucially at Goldman Sachs, this is also about making way for a new level of top talent that are coming through. You've had people leave the management committee just about sometime last year, and it's about these two emerging executives also making their way onto that committee and recognizing that kind of top talent as the bank wrestles with its future here.
Right, joining the management committee. It's interesting where they come from because it is traditional investment banking and markets, showing you that's what's leading the talent again. They're also moving Vivek Bantwal from the investment bank to the asset manager. More investment banking talent going from the investment bank to the asset manager to grow those divisions. Another fun fact, guys, is that Goldman actually gained some market share at the end of last year in leverage finance. That's another area that's kind of included in all of this. Is this kind of coming in an anticipation of a great return of financing for private equity firms that might be looking to exit opportunities or at least cash back out to their investors?
Absolutely. I mean, right, this timing is quite remarkable, Sonali. I mean, you've got the beginning of this year, you're going into a Trump administration where everyone's looking at the rebound in M&A, deregulation. Every bank across the street is doubling down on how it's going to be looking at its advisory businesses, but also crucially where that financing is going to come from. How much of that market share can each of these banks gain, and where are they going to be doing it within those banks? For instance, Citi partnering with Apollo. Every
I was
bank
just
right
looking
now
at it. So you and Sonali wrote that story.
Oh, yeah.
I was just looking back because
We've been talking a lot these days.
Well, that's where this all kind of kicked off. The idea that Wall Street needs help from people like Apollo or Blue Owl to get into this space, and I've just never understood why. Why can't a J.P. Morgan say, "Hey, we're the kings of the castle anyway. We'll start our own private credit group without having to buy anyone or bring in someone from the outside"?
Well, J.P. Morgan has its asset management arm. It's increasingly doing that. Goldman has its asset management arm. It's increasingly doing that. Citi doesn't have its asset management arm in that case. That's why they've had to partner with Apollo. Goldman here, it's trying to make sure that those synergies that it has with its existing private credit arm, it can depend on those. It can really fuel business in both directions to make sure that it doesn't need to look to too many outside partners, that it can keep those profits inside its company.
This whole capital solution thing is like the banker of the future, they say. All the boutiques are finding capital solution banker, Lazard, Moelis, Evercore. It's just a new thing.
Well, it is a fascinating new thing. Todd, congratulations on the promotion. Thanks so much for joining us. Todd Gillespie there covers Goldman Sachs for us now here at Bloomberg. Let's get a quick check on the markets. S&P still down, although not doing nearly as badly as it was at session lows, now off only 0.4%. NVIDIA is a big weight, but not off 4.5% now, only about 2.8%. You see Tesla and Apple down as well. That does it for us today. Bloomberg Technology is up next. This is Bloomberg.